So welcome to Chapter 8. We're still working our way down that balance sheet. We've covered cash, and now we're going to the next asset that we typically see listed, which is account receivables. We're not just going to talk about account receivable here. We are going to talk about all receivables, though. Now, I will go ahead and warn you that chapter 8 is one of the longer chapters, and it is a chapter that historically students tend to struggle with. So, again, I want to really encourage you, if you have access to a printer, to print out those notes, to really engage with the content, to as we start working some of the problems and some of the later objectives, to really pause the video, try to work it, then restart the video so that you can listen to the explanation and check your answer. So the creditor is the one who owns the receivable, the one who is expecting to receive payment. So in our example, Smart Touch Learning is the creditor. They are the one who is owed. The debtor is the one who has to pay. So right now, we're the one who is expecting to receive payment. We will be the creditor. When we get to chapter 11 and 12, we'll be looking at it from the perspective of the debtor. So then we'll be the one that owes the money. So we'll come back and look at these same concepts, but just from the other perspective. So account receivable is money that again is due from customers for a good or service, typically expected to collect within 30 to 60 days. It's a very short term payment period. We call it a current asset because we are expecting to collect it in under a year. Also, you will hear these called trade receivables. Now, trade receivables are any receivables that are the result of a sale. We can have receivables that are not necessarily the result of a sale of a good or service. They're not as common, but they do happen. So trade receivables is a big umbrella account. All accounts receivable are trade receivables. Not all trade receivables are accounts receivable. Now, another characteristic of accounts receivable that I don't have on the slide, but you may want to jot down, is that accounts receivable don't have interest associated with them. So we're not charging interest or collecting interest on this 30 to 60 day, very, very short loan. Now, a note receivable typically has a longer payback term than an account receivable. Doesn't necessarily have to be long term. Remember, a year or less is a current asset. So it could be a 6-month note, it could be a 9-month note, it could be a 12-month note, it could be those would all be current. You could have a 2-year note, a 3-year, a 5-year, a 30-year, a however many year note. The difference is notes receivable again have longer terms than accounts receivable, and they're going to have interest associated with them. We're not really going to get into an interest-free loan, but just FYI, there's no such thing actually as an interest-free loan. So the date, whatever date that is that the note has to be paid back, is what we call the maturity date. And on the maturity date, the note will be paid back as well as all of the interest associated with it. So it's called a note because it's short for a promissory note. And I always say, if you've ever played the board game Life, or Monopoly, and you ran out of money and you had to borrow from the bank, then you got this red slip of paper called a promissory note. It's the same thing. Sometimes you'll hear people call it a car note. If you finance your car through a bank, they'll say you have a car note. That's where the note comes from. Other types of receivables that we may have, dividends receivable. We'll talk about this a little bit more in chapter 13, but if we own stock in another company and that company has declared dividends, then we have a right to receive those dividends in the future, and so we'll have a receivable. If there's interest receivable, so on the note, the customers pay back the interest. With the note, the interest is kept in a separate account than the note itself, so interest receivable. If you get a tax refund every year, then you have taxes receivable from the government. So these would not usually be trade receivables, but they are other kinds of receivables. So let's walk through a couple of transactions. We've already done these before, so if you want to pause the video and try to do them on your own and then restart it and listen to the explanation and check your answer, that would be great. So here we're told that we provided $5,000 of services to customer Brown, and we sell $10,000 of inventory to customer Smith. We're going to ignore that cost of goods sold entry to customer Smith, so we're just looking at recording those two entries where we sold the services to customer Brown and the inventory to customer Smith. Both of those are on account, which means since we're the seller, we'll have an account receivable. So here I have a debit from accounts receivable Brown and a credit to service revenue. And then my second entry would be a debit to account receivable Smith and a credit to sales revenue. Keep in mind we would really make a second entry there to debit cost of goods sold, credit inventory, but we're just ignoring that right now. So we talked about this a little bit back in chapter 3, that when we have accounts receivable from multiple customers, we actually have not just one giant accounts receivable account, but a bunch of little bitty accounts receivable accounts. So here we have accounts receivable for customer Brown and account receivable for customer Smith, because I want to keep track of how much money each one of my customers owes me separately. So when I post these, I have, again, my little T accounts over here, and I mentioned before, these are actually called subsidiary accounts or subsidiary ledgers. Now, we have a giant account receivable account that is called the control account, and the control account is equal to the sum of all of these subsidiary accounts. So when I do my balance sheet, I'm not going to list all of the individual accounts receivable accounts. I'm just going to say accounts receivable is 15,000. But inside, in my books, in my inner workings, I know that that 15,000 is 5,000 from customer Brown and 10,000 from customer Smith. So here when the customers pay me, so customer Brown pays me 4,000, customer Smith pays me 8,000, I want to debit cash and credit their separate accounts receivable accounts. So you could do these in two separate entries, or you could do it in one like we did here. As long as debits equal credits, we can do it in one entry. So I debited cash for 12,000 and then I credited each one of their account receivable accounts separately. So now when I post this, I see that now customer Brown owes me $1,000, customer Smith owes me $2,000. So in total, accounts receivable is $3,000.